you add into it an uninverting of the yield curve, every single time since 1950 that's happened, big recession every single time. And the same thing is true of the SAM rule. Claudia Sam, economist, who talked about the 3-month moving average of unemployment. If it goes up 50 basis points from its low point, you're in a recession. And that's predicted 9 straight recessions in a row with a 100% success rate. Well, guess what? We're up 53 basis points. So whether it be the uninverting of the yield curve, whether it be the SAM rule, or whether it be then raising rates, because most of what they're doing are lagging indicators. They're reacting to lagging indicators. Yeah, things are about to get dirty. You could see the market collapse. You could see a resumption of a fairly decent recession. It's not a good thing, to be honest with you, and the way that it's touted, and the political side of it is even more gross. Like, there's a meeting in November right after the election. They could wait until right after the election to do this. Why are they doing it now with a month and a half to go before the election? Is it political? It sure kind of stinks that way to me.
The US is creating $100,000 in debt every second, with a national debt soaring past $35 trillion, and that doesn't even include unfunded liabilities like Medicare and Social Security. According to Andy Schectman, we're witnessing the weaponization of the Treasury market, and it's only a matter of time before the system collapses. With inflation out of control, the Fed is stuck in a cycle of fake data and bad decisions, driving us toward a full economic reset. Lower rates and a weak dollar, it could spell the end of the US dollar as we know it. Schectman suspects the government is quietly preparing for a massive reset, and the signs are all around us. Are we ready to face the consequences of their actions?
The Fed is full of shit, and you can't really take anything they say with a grain of salt. I mean, in the respect that, going all the way back to 2008 when Bernanke said the subprime crisis was contained, only to watch it blow up a week later. And the same thing is true here. There is no inflation, and then it's okay, it's only transitory, and well, then it's structural, then it's contained. And I mean, everything that they talk about just seems to be mistimed. They're talking about, in this case, lowering the federal funds rate by 50 basis points because of their dual mandate of not only fighting inflation, but also making sure there's full employment. Well, the numbers, as we know, that come out of the Bureau of Labor Statistics are fugazi. We know that. They went back and adjusted 818,000 jobs, but that doesn't take into account the couple 100,000 that they did during the year last year. So over 1 million jobs just vanished, and they touted every single month what great job they were doing on fighting, not only inflation, but making sure that the economy was strong. And look at the job creation. Not only was that fugazi coming out of a pandemic when everyone had lost their job or was mothballed, and now just the reacclimation into the system, those numbers should be parabolic, but they were off by 1 million jobs. And not only that, unemployment or employment numbers are a lagging indicator. So they would tell you that they're already a day late and a dollar short. Will they continue to do it? I don't know. I mean, when we talk about lowering the rates the way that they are, when stocks are trading at or near all-time highs, and at the same time we have our deficit out of control, creating 100,000 in debt every second, 24/7, $1 trillion every 3 months, which took 200 years to do the first time. We do it now in 3 months. We've redlined our national debt, and it's 35 trillion, which doesn't even take into account unfunded liabilities of Medicare and Medicaid and Social Security and government military pensions, all that kind of stuff. At the same time, the Fed is making these mandates based upon fake macroeconomic data, like the CPI or like the jobs numbers. And so when you talk about the CPI, I just saw an interview with John Williams of Shadow Stats. I think everyone should go to his website, and he'll tell you that inflation is 11%. Add 8 to their number, and that's what you get. That 11% would be based upon the way they used to calculate it. So inflation is, in essence, almost 4 times as high as they are telling us, yet they're touting 3% or just over 3.5%, right in that range, as where they're going to pivot. That's 60+% away from where they wanted to be at 2%. They haven't tackled inflation. They haven't beaten inflation. In fact, they've raised the red flag. to inflation, the way they always have, the way that all governments have in terms of normalizing their balance sheet or quantitatively tightening, you get rates up to 5% and the whole thing starts to blow up, just like it started to blow up in 2019 when they tried to raise rates and the subprime crisis happened, just like when the UK tried to normalize their balance sheet and raise rates. What happened? The pensions started to blow up, so they backed off, just like Japan tried to normalize their balance sheet and raise rates. What happened? The Nikkei collapsed, the Dow Jones collapsed, the markets in Singapore and South Korea collapsed. All of these markets collapsed. The carry trade, they backed off. So the point of it is that we've reached a point where we're trapped between inflation and austerity, and governments do what they always do, and that is to choose inflation. Now, the question becomes, what are the unintended consequences? Think about the yen carry trade for a moment. The yen carry trade blew up because rates on the yen went up a tiny bit and the yen strengthened. So wouldn't it be the same thing if the dollar loses ground and rates fall a little bit on the dollar? Because if you're lowering rates, the dollar should fall. And it's the exact same thing in reverse. Are there consequences lurking in the weeds that we don't see? What we are doing is reigniting the inflation engine. And I think that's why you see gold, which they tried to hit right after the announcement, but here it is right back up to $2,600 an ounce, silver back to 31. I think that it's predictable. The question is, do they continue to go down this road and lower rates? If we do, you might as well just put your head between your knees and kiss the dollar goodbye. Because if we continue to lower rates and to give in to inflation, it's over for the dollar on a long-term basis. And what's interesting, you can kind of see that in a microcosm. They lower rates, and what was the first thing that happened? The back end of the curve went up. So the yield on the 10-year Treasury went up as they lowered rates on the front end. And that's just, I think, the world's way of saying, you guys are idiots, and we don't want your duration treasuries of any duration, because why would we? You're going to inflate the hell out of the currency. You're manipulating the treasury market, and in fact weaponizing the treasury market, and your country's a mess. Why do we want your treasuries? Tell us why we should buy it when you're lowering rates, yet you're creating inflation as if money is going out of style. These are very interesting times, to say the least. And then you talk about job numbers. 1.3 million Americans lost their jobs. Native-born Americans lost their jobs in the last year, replaced by 635,000 part-time jobs, mostly by immigrants. It's like 16 straight months in a row of increase in part-time jobs as full-time jobs are being shed. The ones with benefits, the ones with good paying jobs. The whole system is skewed. And if we listen to our glorious leaders telling us that everything is okay, look at the numbers coming out of the BLS, we should strip the L out of the BLS and call it bullshit for what it is. And so, I'm not a fan of it. I don't know where it will continue to go, but I will tell you, if history is any guideline, they will lower rates more. They will give in. That's what both candidates want. Both candidates are talking about lower rates in a weak dollar, which is pretty much the worst possible thing you can do. And so, am I optimistic? No, in fact, not at all. I think that we are on a bumpy road that probably will only get bumpier. You add into it an uninverting of the yield curve. Every single time since 1950 that's happened, big recession, every single time. And the same thing is true of the Sam rule. Claudia Sam, economist, who talked about the 3-month moving average of unemployment. If it goes up 50 basis points from its low point, you're in a recession. And that's predicted 9 straight recessions in a row with 100% success rate. Well, guess what? We're up 53 basis points. So whether it be the uninverting of the yield curve, whether it be the Sam rule, or whether it be then raising rates, because most of what they're doing are lagging indicators. They're reacting to lagging indicators. Yeah, things are about to get dirty. You could see the market collapse. You could see a resumption of a fairly decent recession. It's not a good thing, to be honest with you, and the way that it's touted, and the political side of it is even more gross. Like, there's a meeting in November right after the election. They could wait until right after the election to do this. Why are they doing it now with a month and a half to go before the election? Is it political? Sure, kind of stinks that way to me. So any way you look at it, it's not a good thing. It's not a good thing at all. In fact, I would argue it's the worst thing that we could do. And look, arguably they've been doing this since June. They just haven't talked about it because we've seen rates fall since June. How is it that the mortgage rates are the lowest they've been in like 2 years and they just started lowering rates? It's because they've been under the table buying bonds, creating money to buy bonds under the table, even though they just now announced it. And, again, the solution is simple and it's the opposite of what we're doing. But looking at Trump and Kamala, neither of them want to fix it. They both want lower rates. They both want a weaker currency. And these lower rates, they just fill or fulfill the corporate agenda. So, yeah, I would guess there probably will be more rates lowering, but is that a good thing? No, actually, I think it's probably the worst thing that can happen. It's not a solution. Easy money, not a solution. Think of the Cantillon effect. The Cantillon effect says the people and entities closest to the money benefit disproportionately. Well, look at that over the last few years. All that money created has made the hedge funds and the wealthy wealthier, where they can borrow money at next to nothing, plow it into assets that go straight up in value. Look at the Dow Jones, look at the price of gold, look at the price of everything, real estate, it's all higher. And by the time the money trickles down to the public, they suffer. The people who are suffering just to put food on the table, to pay their bills, and the things that we need, like tuition, like insurance, like food, like rent, they keep going higher. Yet we're gaslit by these idiots who want to actually try and tell us, I mean, which is the craziest thing of all. They're trying to tell us by lying about the stuff in the CPI that health insurance is actually down by 30% over the last year and down, 15 or 20% over the last 5 years. Where are they getting this information? So, yeah, I think that this is not good at all, Danny, and I think it's probably a precursor of much more to come.
Now that you've seen the real story behind the Fed's decisions and the looming economic reset, you're going to want to dive even deeper. The next video is critical. I'll break down exactly how these moves are setting the stage for what could be the biggest shift in the US financial system. Don't miss it, because understanding what happens next could be the key to protecting your wealth in the coming storm.